Bloomberg Audio Studios.
Podcasts, radio, news.
Torsten Slok of Apollo got two benefits there. One, he got an extra 12 minutes to go over all of this. And two, Mike McKee set him up perfectly because, Torsten, you just sat there nodding. You agree, don't you?
100%. I mean, let's look at the numbers. Non-farm payrolls in August was better than in July. The unemployment rate in August was better than in July. Average hourly earnings higher than in July. And you look at average weekly hours, also better than in July. I mean, this report is better than in July. This economy is not slowing down in the way that markets are anticipating. We will not get 8 cuts over the next 12 months. Here you should instead look at this report as this is really telling you that there is a soft landing.
So help me with this. In October, when we look back at this report and we get another revision, a downward revision, don't we have to reframe some of this conversation and just say everything keeps getting revised lower? This is Lisa's point over the last few days. This economy, this labour market is weaker than we initially thought it was.
But GDP in the second quarter was 3%. It was just revised up. Jobless claims continues to be good. Continuing claims was also good. If you look at the daily data for how many people go to restaurants, how many people fly on airplanes, the weekly data from Redbook on retail sales, if you look across the board on bankruptcies, if you look across the board on credit card spending, in the aggregate, the growth data is just not showing signs of a slowdown. It is true that the labor market is weakening, and yes, the JOLTS data has been a little bit, maybe more in balance, as the Fed would be saying. But this whole notion that the economy is slowing down rapidly, it is completely misguided.
What I thought was fascinating, I was speaking to a number of retail executives at this conference this week, and their biggest question was, what's going to happen with the consumer? They didn't know. They had zero visibility. Even though you are seeing some trends, some signs of robustness, some signs of weakness, they said ultimately it just depends on whether they have the money to spend. These labor market reports are raising a red flag for a lot of people, saying if they lose their jobs, they won't. How fragile is that sort of happiness that you're describing to a scenario like that?
Certainly, if we do have a rise in the unemployment rate, so that's not what happened, the unemployment rate went down, it would become a problem. But if you also, exactly as you know too well, look at what they did say, the retailers, during this earnings season. Target said no sign of a slowdown. Walmart, no sign of a slowdown. And also Costco, no sign of a slowdown. You saw Dollar General. Some parts of consumers are under more distress. But broadly speaking, looking at retail sales, both the monthly, the weekly, and across the board on credit card data, there is just no sign of a sharp slowdown. So the bottom line in this discussion is that you only get a recession when you have a really big shock to the economy. And that makes sense, of course, with COVID, Lehman Brothers going under, of course, the bust of the IT bubble in 2000. But this is not an exogenous shock with something coming from the outside. This is all engineered by the Fed trying to slow things down. And now the Fed is telling us that they're about to lower rates. So that's about to counter some of those negative things that have been weighing on the economy.
We get another headline from the Federal Reserve. Mike McKee from the New York Fed President, John Williams.
Yeah, John Williams is saying it is time now to join the party. He is not commenting in his prepared remarks about today's numbers. Of course, he wouldn't have had them ahead of time. But he does say it's time to cut rates. With the economy now in equipoise, which he titled his speech, that means in balance, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. So the guy who's vice chairman of the Open Market Committee is saying we're going to cut rates. He's not yet talking about by how much, but there is a Q&A, so we'll keep an eye on that.
And apparently owns a thesaurus, too, over at the New York Fed. Torsten Slok, what do you make of that, and what are you looking for from Governor Waller?
So I do think Waller will also give some more guidance in terms of what's going on, at least with the bigger economic picture. But I don't think that he will tell us much about whether this is 25 or 50. It requires probably a very important debate, given the spectrum of where FOMC members have been recently in their speeches. Some are clearly saying, some are even suggesting we should have much fewer cuts over the next several quarters. And others, of course, are suggesting that we should go much faster. So I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? I would say, and I would agree with Mike, that 25 is the right number, given that literally everything in this report was better than in July.
Would it be a policy error, though, to go by 50?
See, that opens up the debate about our star and how far do we need to go down. If our star and where we need to go to, and ultimately, so real rates plus inflation, if we only need to go to 4.5, we're not far away from that, so there's no rush to lower rates. If we do need to go all the way down to 2.5 or 3, then there is certainly more of a rush. But given the incoming data across the board is still good, Why is there this rush to cut rates so dramatically, other than the R-star framework, which says that we got to get going?
Jackson Hole's speech was all about understanding the effect that Fed policy has on the overall economy. The conclusion was we still don't know. We don't have a sense of exactly how quickly it gets sort of transmitted and how much of the lag effects that we're starting to see. There is an argument if you cut rates more aggressively now, you can get ahead of some of the lag effects that we haven't yet even seen. Why don't you give credence to that?
Because there are three very important reasons why we did not get that slowdown that we all anticipated for so long throughout 2023. Remember, they started hiking rates in March of 2022. First of all, consumers and firms had locked in low interest rates. AI investment has been very strong, and fiscal policy has been a huge tailwind. All these things combined have been the key reason why the economy has not slowed down. And those things are actually still in place. A lot of people still, of course, have low interest rates in mortgages, in investment grade credit, fixed rate, also very locked in for a long time. So that means that if you do start cutting rates, it's actually the transmission is also going to be weaker on the downside. It was weak when you were raising rates. It's also weak when you're cutting rates. So because of that, AI investment still strong, fiscal policy from CHIPS Act, Inflation Reduction Act, Infrastructure Act still strong. All this argues that the data will just continue to be steady over the next several quarters. There is no reason to expect this to be a hard landing. There is no exogenous shock similar to what we have seen during previous recessions.
Torsten, can we go back to the revision for a second? If you take off the 25,000 we took off last month and you do here for August, you'd get 117. Would you still feel this way if it printed 117?
Sure. Of course, the revisions are very important because we have seen some modest slowdown, but broadly speaking, the data was still better than what it was in July. So taken as the overall picture of, in particular with the unemployment rate, which is especially important when you put that into your Taylor rules and try to figure out what should the reaction function be from the Fed. And that's how all the regional Feds prepare the forecast. And if the unemployment rate goes down, it's hard to argue why they should be going 50. To go 50, you need some very, academic argument about R-star, and you got to get going with lowering rates very, very quickly. And the question is, with the incoming data being so strong, is monetary policy really so restrictive? It doesn't look like it's restrictive. If it was really restrictive, the employment report would be a lot weaker.
Pause, because this is exactly where I wanted to finish with you. You're saying 550 is still not that restrictive for this economy?
So if R-star, if where we're going, the terminal rate is 4.5, is 5.5 far away from 4.5? I know we, have been somewhat, not quite brainwashed, but very distorted by a lot of FOMC members continuously saying we got to normalize rates, normalize rates, normalize rates. But let me ask you this, John. If we really had restrictive monetary policy, why have we for 2.5 years and counting still been getting very good economic data, including GDP in the second quarter at 3%?
The lags are just longer. They might say the lags are just long.
What should be the reason for that? The tailwinds from AI continue to be strong. The tailwinds from fiscal policy is still strong. We have locked in low interest rates for the consumer and for corporates. Where is this very significant transmission of monetary policy?
When we sit here and do this again a year from now, we'll do it before then, don't worry. In 12 months' time, where do you think rates are? They've got a 4 handle, they've still got a 5?
I think that they will be much higher than what the market is pricing at the moment because this is not a shock that is generating a recession. Why haven't we had a recession for now 36 months and counting? I mean, it is really the case that the economy and the economic data has just been much better than what literally any model would have predicted for the reasons that I just mentioned, namely locked in low interest rates, tailwinds from fiscal policy, and AI spending being completely independent of whatever the Fed is doing.
This is box office and we should do it again next week. Torsten Slok,
I'm
thank
ready
you,
next
sir.
month.
Looking forward to it. Torsten Slok of Apollo, thank you very much.